Good evening and welcome everyone. My name is Victoria Fisher and I'm the Program Assistant here at the Institute for Intellectual Property and Social Justice. Thank you all for joining us for tonight's webinar, which is the fourth webinar in this school year's IP for the People Academy series. This series is a free digital open access academy designed for and marketed to creators, inventors, and entrepreneurs from communities of color who have historically and continually been locked out of receiving key knowledge and resources related to protecting and profiting from their ideas. In this series, we offer easy to digest and engaging talks on IP rights and navigating the IP system, highlighting tips and resources via live webinars, which are saved as an on-demand video series on our YouTube page. Tonight's webinar is co-hosted with law firm Allen & Overy and directed to providing information for entrepreneurs on how to raise capital for your business. We're glad you're here for tonight's session and hope you'll join us for future sessions. Please sign up for our newsletter to ensure you're notified of future events. Now, I'll turn the program over to our session moderator, CJ.
Hello, everyone. Welcome to part 4 of the Entrepreneurs web series hosted by the Institute for IP and Social Justice and Allen & Overy. The primary goal of the series is to bring the resources of Silicon Valley to other communities of entrepreneurs. Each webinar features panelists with extensive industry experience who are eager to share their insights, anecdotes, and practical advice with the next generation of entrepreneurs. To start off the webinar, I would request the panelists to introduce themselves with their name, firm title, company, and a high-level overview of the experience related to the panel topic. Wifredo, you can go first.
Hi, good evening. Wifredo Fernandez here. Folks call me Wifi for short. Currently, I serve as head of government affairs in the U.S. and Canada at X, formerly known as Twitter. Over the last 10 years, I've been working in Miami and throughout the country helping build startup ecosystems. Co-founder of the Lab Miami, which was one of the first co-working spaces and incubators in the city. Went on to run accelerator programs at Miami-Dade College and Florida International University, helping commercialize research there. And I've spent the last about 2.5 years as a scout for Lightspeed Venture Partners, which manages over $10 billion as part of a scout program with 40 other scouts where we help source pre-seed and seed stage deals for the fund. So I've been having a fun time over the last couple of years doing that and getting to work with a lot of early stage founders. And I'll drop my link to my portfolio in the chat so you have an idea of the companies that I've been able to work with over the last couple of years. So thank you for being here on a Tuesday evening.
Lata, you can introduce yourself.
Sure. Hi, good evening, everyone. This is Lata Setty. Briefly, I am excited to be here, my first time speaking at this society. I am a former trial attorney, primarily focused on patent litigation in New York and Minnesota. I practiced for about 10 years at various law firms in New York City, including the oldest patent law firm in the world. That had protected flight for the Wright brothers, electricity for Benjamin Franklin, etc. Very exciting time. And after about a decade, I left that to help launch 2 different legal tech startups, both funded out in Silicon Valley by prestigious venture firms like Sequoia Capital, Canaan Partners, Goldman Sachs, etc. My first company got acquired by Thomson Reuters after 4 years, and our second company got acquired about 3 years ago after we built it and scaled it globally for over 10 years. And both companies were focused on bringing cutting-edge technology and digitizing various aspects of legal solutions and the clients who use them. After the acquisition of my last company, and having gone through the fundraising process with various Silicon Valley venture firms, it became very clearly apparent that the way some of my male Caucasian co-founder was treated was very different than how I was treated, whether it was I was a woman or a woman of color, or I was short or wore bright lipstick, I don't know. But about 3.5 years ago, I was, along with two other women, helped launch a venture fund focused on investing in women founders in the US. And there's a longer story around it, but for this brief intro, I started as a patent litigator, then an entrepreneur, and now I'm on the investor side and look forward to learning more about what all of you are up to as well. Thank you.
Thank you, Lata. And Michael?
Hey everyone, excited to be here. And yeah, like Wifredo mentioned, thank you all for coming out on a Tuesday evening. So I'm Michael, and I started out my career back in the investment banking world, but more so focused on advising business owners on ownership transition to their employees via ESOP, employee share ownership plans. And usually at that stage was dealing with more so mature low to middle market companies that are typically hard asset companies. And from there, decided to focus more on what it looked like to really take these companies and scale them. And, you know, as I tell some people, sometimes investment banking feels like you're dating companies, but, you know, you never actually get to commit to the relationship and the work. So what does it look like to scale products and get them to market? And so I took myself over to Discover Financial Services, where I was doing some product marketing over there. And from there, wanted to go even earlier stage. And that's what drove me into impact investing, starting off with Impact America Fund over venture fellowship that I did over there. And then eventually transitioning over to where I am right now as an investor at the Ruthless for Good Fund. And Ruthless for Good Fund, we're the pre-seed and seed stage investors in BIPOC and female founded startups that are intentionally building tools for what I'd like to say is a just society, a livable society, if you will. And we invest in those founders who are building tools within three lenses, which is through first starting with education, starting from early childhood education, going up to post-secondary, with the goal of these tools equipping people and children in society to be able to graduate into the workforce and be effective there. And then we invest in future of work tools. And then the third category that we invest in is what we call access innovation, and really spending time looking at tools that create access to resources that are historically denied to particular communities. So we can think about tools that help bridge the gap with health inequities, or tools for the underbanked, whether on the consumer side or business side. We take a look at those. And so, yeah, well, the fund started back in 2021. And so right now it's me and my partner, Aaron, who are building out the fund. And yeah, that's a bit of background, and excited to be here.
Thank you, Michael. Thank you, all the panelists. Moving on to the agenda of the webinar. In this webinar, we'll discuss how do you raise capital necessary for your new company, and what are the other non-financial resources that you should seek. We'll focus on the capital and non-capital support necessary to grow your new business, where to find them, and how to secure them. We'll cover funding instruments, investment terms, and due diligence, all key aspects related to funding that every entrepreneur should have top of mind. And along the way, our panelists will share their own experience and pro tips, giving us industry insights into how these key concepts play out in real life and lessons they learn from mistakes and success they've experienced. We'll save time at the end for the Q&A, but we'll take questions during the presentation as well. Please use the chat or the Q&A function to submit your questions to the panelists. So Vivi, let's start off with the sources of funding. Fully expecting our new company will be a wild success, where can I get the capital necessary to make business grow?
Yeah, all sorts of avenues to pursue here, you know, depending on timing, depending on type of the product, business model, etc. You know, one of the most precious things you have beyond your time as an entrepreneur, and your people, of course, that help you build a company is your equity. And so along the way, if you're building a company that is going to require more resources in order to achieve kind of the scale that you want, that is your biggest negotiating chip when it comes to attracting capital, right? And certain business models will be more attractive for venture capital. Other business models will be more attractive for maybe traditional investors looking for a lower return. But ultimately, there is this wonderful relationship between capital and scale, and the market that you're trying to go after. So, at the core, there are lots of questions to ask yourself, really about your ambition and what you want to achieve with the company, et cetera. But certainly, capital is that accelerant that helps you, get more market share, scale your business, acquire more customers, et cetera. So a lot of people talk about bootstrapping. There are a few different ways to think about this, but really it's how can you, ensure that your company survives as long as possible without taking outside capital. And so, I think personally, this is my opinion, the best source of funding is your customers, and that's actually driving revenue. At the core of every business, for it to be successful, you need something that people are willing to pay you money for, and you want that to happen over and over again. So Paul Graham, founder of Y Combinator, which is a famous accelerator, we'll talk about accelerators later, has this sort of this framing for a company's survivability or viability. And it's really whether the company is default alive or default dead, meaning that if you had, the growth rate of revenue that you had today, looking at the last few months, with the amount of money that you have in the bank, not being able to raise a single cent more, does your company survive or not, right? And so that's always a good gauge, every few months to be, are we default alive or are we default dead? Knowing how much runway you have. But at its core, bootstrapping really is about using and leveraging your customers to be able to fund the business and continue funding its growth. Friends and family is, what it sounds like. It's the people in your life, whether they're friends, family, rich uncles, friends, family, and fools, as some like to call it. These are the people who are really betting on you. People with resources around you that can take a bet on you as the entrepreneur and the chief executor of all the things that you have to do as a founder. This could come in a lot of different forms. It could be personal loans. It could be, actual investment on favorable terms. And this should always be approached with some caution, and that when money comes between friends and family, there's always trade-offs. And sometimes it could be very informal, but having that formalized is really key. Third, I'll put crowdfunding and competitions in the same bucket, though they are different, but just for simplicity. Crowdfunding, the ability to go on a platform like Republic, and there are several others, to be able to source funds, either for equity or it could be something like Kickstarter, where you're actually delivering product or some sort of reward, and competitions. These are competitions, could be in your local market, could be national competitions, that actually, where the prize is money. But with platforms like Republic, they've made it really incredible and really easy to set up a crowdfunding campaign for equity. Depending on, again, the stage of your venture, and whether, you're looking for, the type of capital that's going to take a big risk, that is looking for an outsized return, kind of high risk, high return opportunity. Those are angel investors. Typically, these are founders. They could be venture investors as well, but they're really making a lot of bets early on in the life cycle of a company. That's why they call them angels, is because they're taking a big risk. But these folks typically are investing anywhere from $5,000 to maybe $50,000 checks in a lot of different companies. And these are the folks that, may follow on after your friends and family. And typically, good angel investors will have a broad network of both talent and capital for your next round of funding, which will be pre-seed round and seed round after that. And that's where you get into venture capital and you start working with more institutional funds that could work on pre-seed, maybe when you're pre-revenue, seed stage, once you have some proof that you're driving revenue, and Series A and beyond. And so these are much more sophisticated investors that will do a lot more due diligence than your friends and family and even your angel investors. But those are, professional investors, the ones that Michael deals with day in and day out that operate up and down the capital stack. And then finally, again, depending on the type of the business, you have programs that provide, favorable loan terms, especially places like the SBA, National Science Foundation, all sorts of government programs at the local, state level that you can explore and leverage, where you can get, favorable terms on a debt basis. And again, depending on the jurisdiction, where you're operating, what type of market you're going after, there are government programs that provide, if you're commercializing research, you have some funds through the SBA. They have a tech transfer program. So there's some, quote unquote, more free money out there. If you're willing to go to Chile or other countries to explore the market, sometimes there are government programs abroad. So there's a program called Startup Chile that I know a lot of entrepreneurs from Miami. They'd go down, live there for 6 months. They get some grant money, they get some incubation and other support services. So again, depending on the business model and what you're building, right? It may be a mix of all these things. It may be just a few of them. But at the base level, you want revenue, you want funding from your customers. And that'll, in my opinion, from my experience, having raised money from outside, there's nothing like owning more of your company 5 to 10 years down the road. So I'll pause there and keep moving. I don't know if there's questions or if we want to leave questions for the end, but yeah, this is just a little bit of the landscape when it comes to funding.
Very, very good insights there. We have an active audience, actually, so we have a question we face. So are there other sources of funding besides those listed on the slide?
I talked about kind of competitions, which come with not just accolades, but capital. Sometimes those will be centered around conferences. So different startup conferences will have competitions, whether it's TechCrunch, Disrupt on the tech side. And they have these sort of Shark Tank type events. So, searching for competitions is good. I know some founders that have, they didn't have tons of friends and family, but they're really good at going out there and pitching and selling their vision. And they have a compelling story to tell, and they were able to, piece together 25, 10K checks, and slowly but surely you have that first 100K that you may need to make that first hire or to build out the technology or to build out the product, et cetera. So I think competitions is a good, at the very early stages when you're just getting started, it's a good way to, one, practice telling your story, but also get a little bit of cash in the door.
Yes, and most recently, I've started to see more pitch competitions in universities. So I know we have a number of students online, and I've seen it on both coasts and in the Midwest. The other aspect is I've started to judge a few competitions now, pitch competitions that are either particular industry sector specific, like let's say AI or health tech, or it could be gender and race specific, like pitch competitions for female founders or pitch competitions for Asians or African American founders. So there's a lot of these that are going across the country that are worth looking at and getting involved in.
Yeah, and I do want to follow up and we'll talk about programs later, but there are a lot of accelerator programs. As I mentioned, Y Combinator, they provide funding and they'll take, I want to say it's 6 or 7 or 8%. Techstars is another popular one with a network of accelerators all around the country. Typically those will invest what's called a convertible note, or a safe, which I don't think we're getting into later when we talk about funding instruments. But these accelerator programs, the notorious ones and the ones that are well run, typically have some investment that come with them. So I would add accelerators to the list as well.
Yeah. And on top of that, I was also going to ask, considering the fact that you all are in graduate programs, there could be opportunities to tie to not just like the undergrad pitch competitions, but a lot of business schools as well have some pretty solid pitch competitions where they're inviting people from the outside. They have localized pitch competitions and then external ones as well. So those are also really good opportunities to tackle.
So I guess in short, a lot of good options, some traditional and some non-conventional. So moving on to discussing each of these funding in greater detail, staying with you, Vifi, regarding bootstrapping, what is it and what is it we need to know?
This is, I think, again, I think it's okay to be biased here. I'm gonna, and I'm just gonna be like frank, and you take that however you may. And I speak, I guess, from my own experience and my own learnings, in that if you are driven, by a true desire to satisfy your customers and sell something that people want, build something that people want, and those people are willing to pay you money. There's no, more incredible route to build a business in a way that's, going to reward you and leave you with more of your company, right? I think at the core of understanding bootstrapping as a viable route is the understanding that, there's always going to be a compromise when it comes to capital, and retention of equity and ownership and control really is at stake as you bring on more outside capital. And so I think there are tons of incredible stories out there of entrepreneurs that, they're putting, their entire, net worth online, betting the farm, using credit cards, personal and business credit cards to get things going, right? And, and it comes down to that. It comes down to a certain level of conviction and comfort and appetite for risk. And so I think the challenge is assessing, being self-aware about that appetite for risk, and understanding what you're willing, to risk to move this idea forward. And so that's where, a lot of the challenges, personal and business wise, come is in those first moments, those first months where you really have to take a hard look and say, what am I willing personally to put on the line here? And then that becomes an important conversation point when you're talking to your first investors, like what skin in the game do you have as a founder in this business? What have you put on the line? Because that's going to speak to kind of your hunger and your drive to be successful, right? So the more you have put in, the more determined you are to make something of it. But obviously there's a ton of privilege that comes with the ability to invest in your own business and put your personal resources to work. Curious if others have thoughts. Michael, I know you work with a lot of early stage folks in this moment.
Yeah, I was just thinking about connecting what you said just now to your earlier comments about doubling down on the fact that your customers are your best form of financing, and the connecting the dots between the two. When you're bootstrapping, and if you have the opportunity to bootstrap and really prove out that your customers are willing to pay for to help scale your business in the future, what that positions you to do is you then have a business that is cash flowing. And with a cash flowing business, you're in a better position to take on, let's say, better financing, from debt financing, if you will, in order to help your business scale to the next growth stage that you'd like it to, without having to give up any more forms of equity, if you will, just because you have been able to scale your business to a point where it's cash flowing and you've got some collateral to give off to debt holders. So that's just another thing to kind of think about as well. Not to say you can't, finance through debt in the future, when you take on VC funding or other funding. But kind of the end lesson, the kind of parting is, with bootstrapping, you're better positioned to retain more of your company, if you will.
Very helpful, Michael. Thank you. So Vifi, I know that you briefly touched upon this topic earlier, but what about funding from family and friends? What do you need to be aware of when you're funding your business using money from family and friends?
Yeah, I mean, again, this is where network and, as we all know, privilege comes into play. Do you have folks in your network, organically, that can support your business? B, are those people willing to take the risk, right? Not just do they exist, are they willing to take the risk on the idea, on you? This is a personal question of how comfortable are you kind of involving, those that you love, and some may not be, loved ones and may not be close family. They may just be acquaintances or folks you went to school with, etc. But I think a healthy amount of involvement is good, because these are the people that you want to prove right. But also don't be discouraged if there are folks that you think are gonna support you, but when it comes to actually writing the check, may be hesitant. I know there were a lot of friends that I thought I would be able to pitch on my business, and when it came down to it, I had more people around me that were skeptical than were actually willing to support it. So I think you find out really quickly once it's actually time to really raise funds from your friends, if you go that route, to see who's actually willing to put funds behind you. And yeah, like I said earlier, sometimes this can be an informal process, but having treating these investors, treating these folks as investors is key, and having everything kind of papered properly, so that there's not any ambiguity about the expectation, about what they're investing in, the risk, etc. Because I think it's easy sometimes for the informality to take over.
And regarding the next topic of crowdfunding, what is crowdfunding and when is this funding source useful? Staying with Vifi again.
Sure. I mentioned Republic. That is an equity crowdfunding platform. I will drop it in the chat here so everyone has the link. There are a bunch just like this. There were some updates to the law several years ago that made equity crowdfunding possible. So Republic takes the approach that they do a lot of vetting. So you have to apply to be able to go onto their platform. Again, there are a bunch of different ones, but this is a platform that then goes out and really markets your idea, and gives you a ton of visibility and momentum when you're doing a fundraise. So it could be a component of your fundraising plan when this could be something that you do after friends and family, or it could be that, you really want to create a little bit of a community around your idea or around your startup, by bringing in a lot more people into the ownership structure. So Republic makes it really simple to do that. So this is equity crowdfunding. I think a lot of us know Kickstarter, which is more just product and creative and project-based crowdfunding, where the reward is not equity in the actual company, but some sort of, whether it's an early version of a product, some sort of other reward that you determine. But those are kind of the two main crowdfunding approaches out there right now. And Republic is a good example of one that's been successful and is pretty dynamic.
Going on to the next source of funding, angel investors. Michael and Lata, what do angel investors provide? Michael, you can go first.
Sure. So angel investors, they're typically your well-off, high net worth individuals who they take on their own money to fund your business, typically at the earliest stage, sometimes at that friends and family and fools round, sometimes just after. Some may even come in along with some institutional investors if they do just have that much capital. And angel investors, you can typically get them two routes. There is the individuals where you find those through your standard form of networking at various events and groups within your city or local geographic region. And then there's angel groups, syndicates, if you will, those that you'd find on Angel List or through some angel groups within your geographic region. And they may have more of a formal process for you to pitch them, if you will, almost a truncated due diligence process that you might see with an institutional fund. But yeah, and I'd say angel investors, they'll typically fund through either taking an equity stake or convertible debt, or pretty traditionally now, a lot of them will go the route of safe agreements, which is a promise of a certain level of future equity once you do have an investor come in and price your business. So I'll pause there and Lata.
I also look at it as almost a sequential approach. Many times angel investors come in early at smaller amounts of investment dollars. They also tend to be often much more hands-off than the venture capitalists who invest at a later stage. This could be different if the angel investor is in the same industry or has domain expertise, similar to or compared to what the startups objectives are. So a lot of times, even if the due diligence is deeper at a venture capital firm, angel investors can be very hands-on and guide you if they're familiar with the area you're working on. For example, I'm an angel investor in a couple of startups. primarily in the digital transformation or legal tech industry, because that is my area of expertise and my earlier areas of practice. So that's another differentiator I have found between the two ways of investors.
Moving on to the next topic, Michael and Lata, let's talk about venture capital. What should we know? Lata, you can go first.
Okay. Um, so I guess venture capital is usually something that you approach to do your fundraising once you have a viable product in the market, or in the venture capital world, it's called minimum viable product, MVP. There's various types of venture capitalists. Some are focused on particular industry sectors, like there's a number of venture capital firms that focus on health tech or feminine tech or legal tech, as I was mentioning. There's also different types of venture capital firms out there. There's the traditional venture firms that you hear about in Boston and Silicon Valley that raise their funds through large institutional dollars like pension funds, family offices, endowments, etc., and often have funds that are, a few $100 million or more from which they invest in. Then there are smaller funds that are focused on a particular niche area, whether it's industry or otherwise. And as an example, our venture fund, which is fairly young and fairly small compared to the big Silicon Valley venture firms, we focus on female founders only, because we are trying to address the inequity of the 2% or less of venture capital dollars that are invested in US female founded companies. And that 2% has stayed stagnant for several decades now. And the numbers look a bit more dismal, even more dismal when you look at women of color founded companies. It comes down to 0.5% or so. So, firms like ours are really looking at how to help brilliant inventors, brilliant founders who are working on very difficult problems, how to get them face time in front of venture capital firms that can listen to what their product or service is, what their solution is, how it fares in the competitive landscape, and help to bring these founders to the table so they also have an opportunity to pitch their company and have successful fundraising.
Michael.
Yeah, definitely. And also, just as part of getting venture funding, I look at getting funding from venture capital institutions as a partnership that's typically ongoing, either through the life of your business or through, call it, the next one or two funding rounds. And so with that, you might have venture capitalists who are on the board with you as you start forming your board, who help you find other board members. And there's lots of different value adds for venture capitalists in terms of venture capitalists that have expertise and networks to help you build a sales team or help you with your people process, or provide resources for supporting the build of your product. And all of these value add services are because the investments that venture capitalists are making, they require a very, very high level of return. And so one thing I'd say is, if you're seeking venture capital funding, you're not seeking VC funding because you're running out of money. You should be seeking VC funding because you want to de-risk something in the next stage of your company so that you can be successful. And by de-risk, I mean get a better clarity around your ability to scale, your ability to get that product market fit to ensure that you have a sizable market of customers that are willing to pay for your product, de-risk your cost structure, if you will. And part of why I do stress that and stress like the high levels of returns that venture capitalists are looking for is because as the founder of a business, you have to understand like what type of business are you trying to grow? Is it a very hyper growth business where your revenues are growing 30% every month? Because that's more so what venture capitalists are looking at. And part of that being is just the risk profile that their investors, called limited partners, are looking for. They're looking to invest in companies that will give them outsized returns that they can't get in the public equity markets, some other private equity markets, or the debt markets. So as a founder, thinking to yourself, do I have the ability to build a business with these dollars from a venture capitalist to scale my business to the point where I can provide this venture capitalist and other venture capitalists with great returns when I sell my business. And as you think about that, you think about what levels of revenue you can achieve. And these are sort of the things that start coming to mind for venture capitalists as they're looking at your business. Can your business sell and essentially return the size of our fund, whether we're a $30 million fund? Can you sell your business and return 30 million back to us or more? If so, you're a strong business candidate to be funded by a venture capitalist. So it's just something to think about, like the path that you want your business to grow, that hyper growth hockey stick path. Those are typically the types of businesses venture capitalists are invested in. If you're planning on going a slower growth path, then may want to look into like some of the other sources of funding, if you will.
We have a question from the audience. Can you tell us a little bit about how your investment strategies may differ from the typical type firms and their approach to investment?
Yeah. Excuse me. So our investment process, it may look a little different. Our process and priorities may look a bit different from your typical investment fund, because for us, we're an impact-focused investment fund. So we're not just looking at the potential for outsized returns when you exit your business, when you sell your business, but we're also looking for the opportunity for outsized impact, social impact on a community. And so with our investments, we are wanting to understand, who is your business targeting? Is that community and underserved community? And if they're underserved, is your business going to service them, not just for a few, like 12, 24 months, but is this going to be a life-changing tool to the way they live and exist, so that they are no longer underserved in the long run? And if we can see that that box is able to be checked off, then that's a big win for us.
We have another question. What are the key issues to focus on to make your company more attractive to investors?
So I'm trying to think of a number of things. The most obvious thing to make your company attractive to investors, I think I'll start at the very earliest stage. Most attractive thing is traction, your revenues. And if you don't have revenues, have you piloted your product in the market and shown a strong feedback from thousands of potential customers, or have thousands of potential customers on a wait list, with a willingness to pay for your products. So that's one thing. Second thing is what I'll call capital efficiency. Can you scale your product? Can you build your product? Can you generate revenue in the most cost-effective way possible? Do you have the ability? Do you need to hire 50 different salespeople at the earliest stage, or can you, as the founder, sell your product at the earliest stage to customers? Because as investors, we're looking for you to be capital efficient. In the back of our minds, we're thinking, are you going to be, we use the term burn, are you going to be burning or spending cash of $30,000 a month, which you typically see in the pre-seed stage, or at the pre-seed stage, are you spending $100,000 a month for your business? And does that spend really make sense for you to continue to grow your business? That's one thing we're looking at. And then the third aspect, kind of going back into revenue, is how well do you know your buyer? What is your unique way of having your product purchased out in the market? Is there some particular expertise that you know about the person, not the group or team, but the person who's going to be purchasing your product? Is there do you understand the problem that you are solving for that purchaser, not necessarily the user of your product? And seeing founders that have that understanding gives us some indication that they'll be able to take this to market and they'll be able to sell it in a way that is very cost effective. And it shows that that company can become profitable a lot sooner. And I'm sure there's a lot of other things that, we look out for, such as just the founder's really strong understanding of the market and a product that shows that it's solving a particular problem that the founder truly understands. But yeah, those three things that I mentioned, those would be primary that I think of.
So moving on to the next topic, staying with Michael, let's talk about loans and grants. What are the key aspects of these funding sources?
Yeah, so, excuse me. Sorry, just getting over a cold. So loans, your typical fundings from lending institutions, and typically have an interest rate on them with a maturity date, where they'll be paid over time. And kind of the beauty of loans is they don't require giving up control or equity in your company. What they do require of just baseline is your good credit. But on top of that, kind of what I mentioned earlier about having collateral assets. Collateral assets could be the revenues that you're generating or the receivables that you have. Some of these banks might require that. Those assets could look like your storefront if you have in-person business. And so there's a variety of loans out there that you can look at for, fast-growing businesses. There's venture-backable businesses as well. So there's also venture debt loans, which focus on loans provided to companies that are that have been venture-backed, and they may come with a bit of a higher interest rate thereabouts. But there's also equipment financing, there's receivables financing as well, and there's revenue-based financing, where you're financed based off of your revenues, and how much the lender is paid is extracted from the revenues that you generate. So lots of different options when it comes to lending, just because it depends on the stage of your company and what you have as collateral to be able to take on that loan. But the other aspect of loans to kind of keep in mind are debt covenants, and ensuring that you are building a business that can meet those that can meet those particular debt covenants. What I mean by debt covenants is lenders might require that you have a certain level of EBITDA, earnings before interest and depreciation, have some level of EBITDA before, compared to the amount of debt that you have or the amount of interest that you're paying. And there's lots of these different covenants that you have to ensure you're meeting over the life of the loan. So just something to consider. Grants, on the other hand, they're, similar to loans, you're not giving up any control or equity. They're a bit more difficult to find. You can get them through some accelerator programs have grants that they offer for particular industries. You have foundations, nonprofits, different universities and government entities that provide funding through grants. Kind of the downside of some of them is some may have restrictions and obligations based on what you can spend it on, and may require some level of reporting, if you will. So definitely something to look out for. And the approval processes can vary depending on who you're getting the grant from. So yeah, I'll leave it at that.
Thanks, Michael. Back to Wify. You briefly discussed the development programs. Could you please tell us a little more about what they can provide to startups? And to start, what type of development programs are there?
Yeah, absolutely. I think across all of these, it comes down to like what talent can you surround your startup with, whether it be advisory, whether it be funders, all sorts of expertise on different sides of the business, all with varying degrees of intensity, with varying degrees of programming. So first, incubators. Incubators are sort of a mix of, providing physical space and sort of an ecosystem that wraps around a particular startup. Typically, these are for, idea stage, pre-revenue, where you might get access to some space, access to some programming, usually kind of short-term programming, a matter of weeks or a couple of months, really just so you have a bit of a community around you to help push your idea forward and to test your idea in, let's call it, a safe space. So these will typically come, as part of an application process. They shouldn't cost you money. It may be competitive to get access to. Sometimes it's in exchange for equity. But I always caution folks to be wary of giving away your equity for free. So if you are giving away equity for not receiving any capital and getting, quote, kind of access to a community or space, or you want to be very clear about and clear-eyed and eyes wide open about what you're actually getting in return, because that equity is tough to get back. So there are a lot of incubators that won't require equity. Then you have accelerators. I think I spoke about Techstars, which is a popular accelerator network. Techstars has kind of made a business out of accelerators, whereby they partner with large corporations that'll create kind of vertical specific and very niche accelerator programs. So you have, I know JP Morgan has one. Nike used to have one. There are all sorts of health tech accelerators that are operated by Techstars. So Techstars is kind of created. They and Y Combinator were two of kind of the marquee original accelerators that really have had a ton of exits and tremendous success. So they're a pretty good benchmark. These accelerators will typically be 10 to 12 weeks of intensive programming, surrounded by, successful founders and mentors, and usually culminates in a demo day where it's, a bigger pitch day to investors. Accelerators, the best ones, will put forth some capital, could be 50, 100, 150K for typically less than 10% of your company. If you're doing an accelerator and giving up more than 10%, I would, be cautious and really evaluate what you're getting for that amount. But there are tons of accelerators within universities. I used to run one, and a lot of different ones out there. So there's a marketplace for them. There is competition to get into them, and sometimes it takes kind of multiple tries. But these are really great ways to get some validation from really seasoned investors, get some momentum. You're in kind of a pressure cooker and kind of time-bound experience that really forces you and your co-founders, if you have a team, some people go through these alone as solo founders, to really, prove out whether you have something at the end of those 10 or 12 weeks. So I encourage folks to, evaluate whether accelerators make sense for them, as they typically bring a good network. And then you have government programs. SBA has a lot of these. National Science Foundation has others. These will be kind of regional and local in nature. Less so here in the States that we have a national program. You'll see that in a lot of emerging markets. I mentioned Chile, Colombia, Brazil. These have like pretty robust national startup programs, and they're investing a lot in early stage startups. But government programs, like Michael alluded to, sometimes come with some caveats and other obligations. But these are typically, at least in the States, from my experience, don't come with a ton of capital, but do come with some, good networks of expertise. So the SBA, they have small business development centers that are really good resources in different regions. So the SBDCs are good resources to check out. And then you have mentorship networks. I'm a member of one called VC Familia, which has a sister organization called Founder Familia. And this is a network to help Latinx, founders, and doesn't come with any costs, just kind of good intentions of kind of bringing to bear, your experience and leveraging that, and being like just a positive member of the community. And so you have a lot of different mentorship networks where you'll have a mix of expertise, to give you feedback on your idea, open up opportunities for you, and maybe provide some very special expertise.
Lata, do you have any experience to add here?
There's a really good entrepreneurial organization called TIE, which stands for the Indus Entrepreneur. It started off originally of entrepreneurs in the US from Indian origin, but now it's not limited to South Asian entrepreneurs, but it's the world's largest entrepreneurial organization with 30,000 people. So check out some of their events and training and workshops at tie.org, and there's local chapters all over the US. I would also look into your universities if most of you are college or grad students, because they would also have entrepreneurial networks, would be the starting point at your schools as well.
Moving on to the next topic, VP. Once you have decided on the appropriate form of funding and have people seeking to invest, what are the key terms investors will want to exchange?
Sure, happy to speak to some of these, but I would recommend you consult your attorney when it comes to structuring the deals. I mean, in the earliest stages, sometimes these terms are set for you, sometimes by the accelerator program, et cetera. But yeah, equity is your ownership in the company. This is ultimately your way to participate in the profits generated by your company. And so, as I said before, this is so very precious. Depending on the type of entity that you create, there will be different factors that really drive your ability to control the company, right? So depending on whether you're a limited liability company, S Corp, C Corp, different governance structures for each of those companies, and different types of ways that you can structure the company in order to manage the company and really set up kind of governance over the long term. Again, it really depends on the type of scale that you want and the ambition of the company. Some will stay LLCs their entire life. Some start off as LLCs and then they'll convert to an S Corp or a C Corp. You have public benefit companies, which are also unique when it comes to the mission-driven for-profit companies. But yeah, ultimately, as I alluded to earlier, as you raise more capital from outside investors, those investors, unless it's debt financing, will want ownership in your company. And so as you are more successful, you have more leverage with those investors. As you have more revenue, right, you need less of their money, perhaps. Again, depending on your ambition and the potential scale of the venture. So it's always a negotiation at each level of fundraising is how much equity founders retain, how much you set aside for employees, and how much kind of each of the investors that come on are getting. And over time and over rounds of funding, right, there's certain dilution that happens as the company is valued at different levels. So ownership and control may vary as time goes on. But there are ways, again, to structure your shares and so forth, to retain certain control, et cetera. So it really comes down to, the governance structure and how you set up your shares over the long term. But typically, at the earliest stages, when it's, just a couple of co-founders, you may not have a board as you bring on the first. Could be a super angel, it could be an early stage venture capital company. They may want a board seat, and you may want someone else to pitch into the governance of the company. But again, depending on the legal structure of your company, the governance may look different. But yeah, typically you have a small group of people, 3 to 5, in the earliest stages that are really managing the affairs and stewarding the company.
Staying with VP, so why are voting rights important for investors?
It depends on the company. I mean, if you are kind of building an enterprise that is reaching a certain scale, and it could be that the ambition is for it to go public, and you as a founder want to retain the ability to control the direction of the company, right? How you structure your shares and how you structure voting rights is really key. I think having really great counsel at the very early stages is crucial and critical to like the long-term viability of the founding team, to be able to control the direction of the company, because over time, as more capital comes in, more people join your board, your influence may wane. So it's really important over time to keep your governance kind of vision and process in check. That's kind of how I think about it. But I welcome Michael and Lata to chime in here.
Yeah, I don't think there's anything extra that I would add generally. I get it.
Same here. We feel you covered it comprehensively.
Cool. But yes, it's worth investing the resources in good legal counsel at the very early stages so that you have a clear vision, as you raise money and as you scale of how you're going to govern the organization.
Absolutely.
Saying it briefly, what can you tell us about the liquidation terms?
I haven't personally dealt much with liquidation preferences, just because I haven't run like a venture-backed startup. And frankly, the scout investing that I do at the pre-seed and seed stages, like you're typically not, you're typically not, the most senior when it actually comes to that liquidity event and investors, institutional investors that come after you. But basically, as you structure your shares and structure your investment over time, and raise more capital, right? You'll have certain investors that will want a liquidation preference. Could be because of the size of the check that they're writing, is often the case, or the stage in which they're investing. But yeah, this is when you have an exit, whether it's an acquisition or you go public. When there is a liquidation event, it's the preference given to different classes of investors along the way. So again, a technical and legal term that you definitely want your attorneys when the time is right to really scrutinize, and to understand who where people sit in kind of the capital stack, and cap table, the capital table, which kind of represents all your different owners. Michael, I'm curious, yeah, what you guys aim for when you make your investments.
Yeah, similar to what you mentioned, at the earliest stage, liquidation preferences aren't really a thing that's negotiated. We would get liquidated just the same as other preferred shareholders. But you have some other investors who may come in later stage, and maybe your company is in crisis and you're looking for investors who are saying, all right, you're in crisis, we believe in you, but just to de-risk, we want to make sure we get our funding first. They may have liquidation preferences where they have a 2x multiple, which essentially is saying that an investor with the 2x liquidation preference will get paid back double their initial investment, no matter what, upon the exit, just to take account for that risk of them investing in you at that risky stage. You might have some investors that come in when your company's much bigger, right before an IPO, who don't have the ability to have as much equity in your company, but may put in liquidation preferences as a way to ensure that they're getting some capital early. So it kind of varies depending on the situation.
Thank you, Michael. I know we are slightly over time, but Lata and Michael, if you could quickly walk us through the due diligence phase. Say the startup owner say, I want to be prepared once we sign the term sheet. What is due diligence, and what can I do to facilitate a smooth and efficient due diligence process?
Yeah, so in the quickest way I can put it is I look at due diligence in two phases. There's due diligence before you get approval to be funded, and then there's due diligence after you get the approval. Due diligence before the approval, that's probably going to be a lot of the heavy lift, and really For your investors, or whether it's for a bank or lender, part of their process is to write a memo or just have a full description of why they should be lending or investing in your business. And a lot of what that looks at is your corporate structure, your capitalization table, who has invested in you, what equity looks like. A lot of that looks at your pipeline of customers, your understanding your product, understanding your market, and your market opportunity, your risks in the market, and who your competitors are, and the talent behind your team to make this business meet the growth that it plans to meet. And so, as far as preparing for due diligence, you need to prepare all of those different things to support your potential investor or lender to make the best case for investing in you. And then once you get approved for investments, then there's a few things that you just need to make sure you have ready to go in a data room. And those are things like your certificate of incorporation, those corporate records and documents, your list of employees, and also just financial reports as well, whether it's reviewed reports, and as well as any documentation on your intellectual property, agreements you may have with customers, and your pipeline, and also just looking at any legal risks that you may have or environmental risks, making sure that that's cleared up. And those are things that you want to make sure you have the documentation for before you get funded, because they will look into that.
Lastly, what does it mean in practical terms? What concrete steps can I take now to set up myself for a smooth due diligence process?
Yeah, absolutely. So as far as the steps, one, having two different data rooms. So I say two different ones. One, which is, kind of your early teaser data room for investors as you're pitching them. And that typically has your pitch deck, some financials and projections, typically has some market information. And then you've got your more robust data room for once you get into advanced due diligence, where that has references that are ready for you to give to investors, references that can vouch for the quality of your product, the quality of you as a founder, CEO, and also in that advanced diligence data room, having testimonials of your product, a robust outlook of competitive analysis, and make sure you do have competitive analysis. Don't set yourself up to be that founder that says, I don't have competition. You always have competition. People are spending time doing something else other than using your product. So make sure you understand that and have the defensible market information to give to investors that show that it's a problem that people are willing to pay for, and there's enough people in your market, whether it's the US or globally, that are willing to pay for your product.
Thank you, Michael, Vivi, and that's all that we had for the agenda today.
All right. Thank you all. It's great chatting with you.
Thank you, everyone. Thank you so much. This was really informative, and I just want to thank you as serving as guest lecturers for the IP for the People webinar series provided by the Institute for Intellectual Property and Social Justice. I definitely learned something new, and I hope everyone in the audience did as well. Luckily, this was all recorded, and we'll be sharing this on our YouTube page at a later date, and we'll be sending an email out to everyone once that video is uploaded. We also hope that you'll subscribe to our newsletter so that you can be informed of future events, including the next sessions of this webinar series. So thank you again to all of our wonderful speakers and our moderator and to everyone who participated tonight. And I hope you have a wonderful evening.